Good morning, everybody. It's 10 a.m. on Tuesday. It's time for our weekly webinar. Happy December. I know December started last week, but, I'm just so happy to be ending the year, in a very positive way in the markets overall. And we've done a lot of great work for our clients, and we've had a lot of great opportunities to talk to you every week and have these discussions about these important retirement planning topics, these critical items that can make such an impact to your comfort and enjoyment in retirement. So I'm just really happy to be doing this for you. And we're going to be talking about our year-end checklist. So a few weeks ago, we talked about year-end planning. So you can find that. I'm going to write that down as a linked video. Let me see, year-end planning. So you can go back and watch that video. We'll include it on our links. But today we're going to be talking about our year-end checklist. So we're going to go over our slot updates. We got a really good ones, I think, today and all the time. But I especially like Andy's piece today, Andy Ives' piece today that you'll like, I think. And then we're going to go over some market reports, and we have a headline about Consumer Price Index, or CPI, today. And then we're going to talk about our financial planning topic, or our financial 15, and that again is year-end checklist. So if you're just joining us on YouTube for the first time, please hit the like, subscribe, and notification button so that you make sure that you get notifications from videos. There was a commenter that said, when are you going to put out another video? So I let this person know that we do this just about every week, other than weeks that follow market holidays, because there's a lot of information to compile to bring this broadcast to you. And that's typically not available when there's a market holiday on Monday, or if a big tree falls on my car, then I sometimes have to not have a podcast or a webinar that day. But let's go on with our discussion today. So the top headline, of course, is the Consumer Price Index. So the Bureau of Labor Statistics released the Consumer Price Index this morning. You can find that. It comes into my inbox. I get BLS updates. That's the Bureau of Labor Statistics updates on a regular basis, but I received 3 this morning, and it had to do with the Consumer Price Index nationally and regionally to the Mid-Atlantic and the Philadelphia area here. But you can access this. So what's the information? Over the last 12 months, the all items index increased 3.1% before seasonal adjustment. So that is very much in line with what the expectations were. So we don't expect to see big movement in the markets because of it, but who the heck knows? It could go either way, and I don't have a ticker up right now to tell you what is happening, but we'll see, really what the effect is of this report from the BLS about Consumer Price Index. But I'll just read to you some of the release from the BLS. The index for shelter continued to rise in November. Obviously, it's housing, offsetting a decline in the gasoline index. So gas went down, shelter rose, so they're offsetting each other. The energy index fell 2.3% over the month as a 6% decline in the gasoline index more than offset increases in other energy component index. So gas went down 6%, and that's not uncommon with fall. This is November's report, so that's not uncommon in the fall to see a drop in gasoline prices. The food index increased 0.2% in November after rising 0.3% in October. The index for food at home increased 0.1% over the month. So when you hear about these small percentage increases, it's typically month over month. And then when we're talking about year over year, that's where you hear 3.2 and 4%, things like that. So the index for food at home increased 0.1% over the month, and the index for food away from home rose 0.4%. The index for all items less food and energy, so takeout food and energy, rose 0.3% in November after rising 0.2% in October. So again, that's month over month. Indexes which increased in November include rent, owner's equivalent rent, medical care, and motor vehicle insurance. Boy, big increase in insurances this year. So when we do our financial planning process every year for clients, we really dig into expenses, and that's a differentiator for us as our firm, and something I think that most planners just gloss over. Most planners, unfortunately, and I'm being critical, I apologize, but I have the opportunity to coach folks all around the country, but most people say, okay, you're telling me you're spending $5,000 a month, that's what we're going to record in our financial plan, and that's usually wrong. Most times that's wrong. Even if you're a detailed individual and you keep track of it, I'm telling you that we work with a lot of engineers, and engineers are typically really detail-oriented folks who keep good records. And still, when we go through the expense portion of our financial planning, things come up that aren't typically being considered. And sometimes it's thousands of dollars a month, which, of course, could mean you're drawing more out of your retirement when your retirement comes about. Most planners just take that $5,000 and they say, okay, well, that's it. You've got to dig in. And here's my point. So as we dig into these expenses, we might see that, well, hey, you said you spent $5,000 out of pocket in medical costs last year, and you've got $3,000 projected this year. Sometimes it's zero. And we want to make sure we're identifying that. So sometimes we're saying, well, you had $5,000 last year. What was it? And people say, oh, I forgot to include that. Let's take a look at what it was, and we identify those medical costs. But we're comparing year over, just like the Consumer Price Index does, month over month, year over year costs. We do that for the individual. So we look at your individual expenses and say, okay, last year you paid $2,000 for auto insurance. Now it's $3,000. Is this an estimate, or did it increase? And what we're seeing is that property and casualty insurance, like auto and home, especially if you're in an area like Florida, especially oceanside properties, New Jersey, any oceanside properties, we're seeing significant increases in property casualty insurance. My own auto insurance. I put a 16-year-old driver on last year, and that skyrocketed it up. But we had a significant increase in our auto insurance. And we have, other than that tree falling on our car that I told you about a few months ago, we haven't had any claims, and that wasn't our fault, obviously. But big increases in insurance. All right. The energy index. Let's see. Hold on. Where were we? All right. The all items index. This is from, again, the Bureau of Labor Statistics CPI report. I'm reading just some excerpts from that. The all items index rose 3.1% for the 12 months ending November, a smaller increase than the 3.2% increase for the 12 months ending October. The all items less food and energy. So again, removing food and energy from that. Rose 4% over the last 12 months, as it did for the 12 months ending October. The energy index decreased 5.4% for the 12 months ending November, while the food index increased 2.9% over the last year. That is the CPI report. So now let's go into our Slott report. So I'm going to share this screen with you here. And last week, Andy had this Bad Santa and Grinch offer. Horrible IRA advice, part one. I didn't have time to read it, to share it with you last week. Maybe I'll be able to loop it in next week. But I really like some of the items in this part too, so I wanted to include it. It's a little long, but hang with me here. So this is from our friend Andy Ives from the Slott Group, and I just think this is funny. The investment advisory firm of Bad Santa and the Grinch continues to disseminate misinformation and lousy, no good, rotten to the core IRA advice. As we saw in Bad Santa and the Grinch offer horrible IRA advice part one, I guess we're going to have to read that now. Next time, the two unsavory characters take great joy in fouling up not only your holiday, but also the qualified status of IRAs. Here are some more fish bones, brown banana peels, coffee grinds, and raccoon meals from their dented trash can of IRA assistance. Now, this is kind of obviously tongue-in-cheek, but these are things that we see day in and day out from the Slott Group, who have these things that they have to help unravel all the time from consumers, individuals, financial advisors, CPAs, attorneys. So it's while it's funny, it can also be deeply damaging to your financial plan. So bad Santa, under 59.5 and converting your IRA, have the taxes withheld, and it will be glorious Roth day. No, sir, bad advice for anyone doing a Roth conversion under 59.5. Do not have taxes withheld from the IRA. Why? Those taxes never get converted. Technically, they are an early withdrawal and will be subject to a 10% penalty, assuming no exception applies. There are some exceptions. Be sure to have available cash from another account to cover the taxes due. Folks, believe it or not, we see this. We talk to people about Roth conversions all the time. We think it's a really, really great tool to move you from, tax inefficient, and as my mentor Ed Slott says, forever taxed to never taxed. But if you're under 59.5, you cannot withhold taxes from that transfer. If you're over 59.5, you can, and you should do the math to see if that makes sense. But if you're under 59.5, with few exceptions, you'll get penalized for that. But people do it, and they don't realize it until it's too late, and you cannot undo it. No more recharacterizations for Roth conversions. The Grinch, the backdoor Roth is a marvelous technique to cherry pick dollars for a tax-free conversion you seek. Untrue for anyone with a mix of pre-tax and after-tax non-deductible dollars in the combined total of all their IRA, SEPs, and simple plans. The pro rata rule must be considered. You definitely cannot cherry pick the after-tax dollars for conversion. Pro rata dictates that any conversion will include a mix of pre- and after-tax dollars based on the ratio between the two. So a lot of people see these things online and on YouTube. There's YouTube financial gurus. But and they hear about these backdoor Roth contributions. I make too much money to do a Roth contribution, but hey, I've heard that I can do this backdoor approach where I contribute money, non-deductible contributions to an IRA, and then I immediately move it to a Roth IRA via conversion, and I don't pay any tax on that money. That is not necessarily true. We have this pro rata rule that we have to pay attention to, and it can affect the amount of money that you can convert tax-free. So I, of course, have a video on that. So I'm going to write that down. We're going to include backdoor Roth contributions video. Let's see here. Moving on. Bad Santa, 60-day rollovers are the best way to go, and you can do as many as you want. How could you not? How could you not know? How could you not know? Okay, no and no. The safest way to move money between IRA accounts is via direct transfer. This is a non-reportable transaction that eliminates the possibility of missing the 60-day rollover window and all the consequences that follow. Additionally, while direct transfers are unlimited, you can do as many as you want throughout the year. You can only do one 60-day IRA to IRA rollover per 12 months. Not calendar 12 months, but your 12 months. If you did it in March of 2023, you have to wait until after that date in 2024 to do another 60-day rollover. Absolutely no reason to do a 60-day rollover, folks. If you're transferring funds, try to do another within that period, and it will be a distribution that cannot be reversed. Cannot be reversed. The Grinch. While within your IRA, buy a cozy Swiss chalet, and when you vacation at that location, 'twill be a wondrous stay. No, it will not, because this is a prohibited transaction. You cannot use IRA money while it is within the IRA to benefit you personally. Owning a rental property within your IRA is perfectly acceptable, although not recommended. But it's perfectly acceptable, but you cannot use the property. In fact, your spouse cannot stay at the property, nor can any lineal descendants, children, parents, grandchildren, as they are considered disqualified persons. This will result in a complete distribution of the account. Really good advice there. Bad Santa, 'tis the season for giving, and the halls we shall deck. Then late in the year, write your QCD check. For those with checkbook IRAs, it is not a good idea to wait until the last minute to write your QCD. That's a qualified charitable distribution check to charity. Why? The custodian may not recognize a distribution until after the check is cashed. So if you sent that even today, here it is 12/12, can you with certainty know that the charity you're sending that check to is going to cash that check by the end of the year. There's no way to be certain about that. The custodian may not recognize the distribution until after the check is cashed. Checks written to a charity will qualify as a QCD, but the check must be cashed before the end of the year to qualify for 2023. Bad Santa and the Grinch can wreck an IRA, which would surely put a damper on the holiday. Shake your presents and listen. Bad advice snakes could be boxed up and hissing. Like the terrible no good guidance above, such gifts are delivered with absolutely no love. Let's hope Bad Santa and the Grinch find their way. Maybe their hearts will grow 3 sizes someday. Excellent job, Andy. Excellent job, if you're listening. So now let's talk about the Slott Report mailbag. So these are questions that come in from consumers and even financial planners, financial advisors, attorneys, CPAs throughout the country to the Slott Group because, again, our friends at the Slott Group are the resident experts in IRA distribution planning. Nobody has the network of analysts and experts that Ed and his team have. And Andy, this continues with Andy again. So the question here, this is a good one. My brother passed away in May 2023. He had a small IRA with no beneficiaries. Right? If I had a buzzer sound, hit that buzzer sound. Always, always, always list your beneficiaries. He was 73 at the time of his death. His estate is to be divided equally among his 8 brothers and sisters, ranging in age from 61 to 77. He was passionate about a small wildlife research project in his later years, and some of the beneficiaries would like to transfer their benefit to the nonprofit. So first question, can you make charitable donations out of an inherited IRA? Good question. Number 2, can each beneficiary, no matter their age, make a donation because the original owner was over 70 and a half and taking RMDs, or do they have to take the distribution, recognize it as income, and make the charitable donation individually? Really great questions because you have to be over 70 and a half to contribute via qualified charitable distribution, and that's what this is getting to. So this is from Kathy. The answer is, Kathy, bad news first, then some possible good news. Since the estate is the beneficiary, we would typically be forced to open an estate-owned inherited IRA and follow the rules applicable to estate beneficiaries. One such rule is that estates cannot do QCDs, qualified charitable distributions, because an estate does not have an age, and that was the period. That's why. So the QCDs cannot be done by an estate because the estates don't have an age. Yes, QCDs can be done from an inherited IRA owned by living people who are over or 70 and a half or older, but estates are not living people. As such, in order to get IRA dollars to the Wildlife Research Project, taxable distributions would need to be paid out of the estate-owned inherited IRA to an estate account and then distributed to the estate beneficiaries. These dollars could then be donated to the charity, and the taxpayer would follow the standard charitable donation rules. On the bright side, we have seen situations where IRA custodians have allowed individual inherited IRAs to be established for the estate beneficiaries. And there was a good piece that Andy previously did about this where they referred to it as an estate bypass. And I think the custodian they referred to was actually Charles Schwab, who is the custodian that we use. But this does not give you license for clients of ours to not name a beneficiary. That's something I absolutely don't want to see. So anyway, let me go back. On the bright side, we have seen situations where IRA custodians have allowed individual inherited IRAs to be established for the estate beneficiaries. He references his October 18th Slott Report named Estate Bypass, Spousal Rollover, when the estate is the beneficiary, referred to by some as an estate bypass. These accounts must still follow the payout rules, 5-year rule or ghost rule, applicable to the estate beneficiary. But at least the estate can be closed and the estate beneficiaries will have their own inherited IRAs. Here is where things get murky. Assuming the custodian allows this state bypass, it's no guarantee. An argument could be made that since the new inherited IRA owner is now a living person with an age, a QCD, qualified charitable distribution, could be done if the IRA owner, the new IRA owner of the inherited IRA, is age 70 and a half or older. There is no official governing rule for this, but in the spirit of giving and assuming the estate bypass is allowed, I think it could be acceptable. You may want to discuss this with your attorney who is handling the estate. Good discussion. Andy, next question. That was a big one. Hi, Team Slott. My wife and I converted a portion of our traditional IRAs in 2010 when the opportunity first was available for higher earners and the tax. Remember, there used to be income limitations on how much you could convert, just like there's income limitations on how much you can contribute. 2010, that went away. When the opportunity was first available for higher earners and the tax liability could be spread over 2 years, my wife recharacterized the entire balance before the deadline in October 2011. We used to be able to recharacterize Roth conversions. Can't do that anymore. And has held no Roth balance since then. No contributions or conversions. She continues to be a skeptic of Roth IRAs. Who is this person? I'd love to talk to her, which I use as I've learned from your team. She hates to pay taxes in advance. I'm concerned whether 2010 Roth conversions started her 5-year clock given the recharacterization subsequent zero balance. Maybe I will finally convince her to do Roth conversions. She also might inherit a Roth account or inherit Roth accounts should I predecease her. I'd hate for her to need to start a new 5-year clock in either of these latter two scenarios. We are currently 68. Does her 2010 Roth clock still work? I do have the paper statements documenting that account. Thanks for your deep knowledge, and that's signed by Steve. So here's the answer for Steve. Your wife's Roth 5-year clock has not started. The 5-year clock is it's not as confusing as RMDs, but it is a confusing rule, and that's, again, why as part of your team you have to have a qualified financial advisor, financial planner, certified financial planner. And if you're nearing retirement or in retirement, that person should be absolutely part of the Ed Slott group. And in my opinion, and it's just because you're part of Ed's group doesn't mean you're expert in this. So you got to find your expert. Some people are still working on getting there. So since she recharacterized her conversion back in 2010, 2011, she essentially erased the original transaction. And since she has made no Roth IRA contributions or done any conversions in the eyes of the IRS, she has never had a Roth IRA. Interestingly, if a person were to open and fund a Roth IRA, but then subsequently take a full withdrawal and close the account, that would still start and maintain the 5-year clock. As for your concern about your wife needing to start her own 5-year clock in the event of you predeceasing her, that is not an issue. This is important. If you were to predecease her, the Roth IRA distribution rules allow her to leverage your existing 5-year clock. That last bit is really, really important. So for some reason, if you can't convince your spouse of all the good about having your money in a Roth IRA, whether it's through contributions or conversions, and they inherit that account, they carry over your 5-year clock. So if you've met your 5-year requirement, or if your clock is still ticking, then your spouse gets the benefit of that, even though you couldn't shake them in the right direction. All right, coming back. And that's a lot of information. I just want to remind you, if you want to reach out to us with questions, you can do so by reaching us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if you're just listening to this broadcast, and I know a lot of people listen to it while they're walking, working out, something like that, I hear that, you can see all this and you can read along with us. And I like the whiteboard, especially in the last part, the Financial 15. So if you're just listening, just go to the YouTube channel and you can see everything. Even just for those segments. I didn't mention this in the beginning, but we do index these and add chapters. So you can just go to the part that interests you. And what we also do is we spin off that Financial 15. If I get long-winded and that last segment is longer than 15 minutes, we break it down into shorter chapters. So you can just watch maybe a 7-minute video or a 10-minute video, whatever they break out to be. Sometimes it's the full 15 minutes, but that's how we break it down. All right, so let's go into our market updates. So here's some information from our friends at Cornerstone. And I'm just going to put our website up there while you're listening to me. So this is week in review from December 4th to December 8th. We got what's called the ISM Services Report. The and I'm going to explain what that is. The ISM surveys non-manufacturing or services firms, purchasing and supply executives. The service report measures business activity for the overall economy above 50, indicating growth, while below 50, indicating contraction. A measure of the activity that I just explained in the biggest segment of the economy rose 52.7 from 51.8, while new orders, the forward-looking component, stayed steady at 55.5. Readings above 50 indicate expansion, as I told you, in activity. So readings above 50 indicate growth, below 50 indicate contraction. So we're seeing above 50 in each one of those readings. So what does that mean? The economy continues to be split, with manufacturing readings coming in at recessionary levels, and service sectors, that's what we just talked about with the ISM report, continues to expand. So we're seeing a drop in manufacturing, we're seeing expansion in service. The Fed's rate hikes are having some impact, but not to the point of pushing the overall economy into a recession. So we'll see if that soft landing, or some people are talking about no landing, holds. And then we also had the JOLTS report. So what is the JOLTS report? You hear these things, maybe if you pay attention to the channels. That is the Jobs Opening and Labor Turnover Survey. It's a monthly report done by the U.S. Bureau of Labor Statistics that collects data from employers in order to measure job openings, new hires, and the number of employees who quit or were laid off, and other forms of labor turnover. So what did that report tell us? Job openings fell from $9.4 million to 9.4 million jobs to 8.7 million jobs, the lowest level since March of 2021. While the quit rate stayed elevated, but well off the high of 3% at 2.3%. The ratio of opening to unemployed dipped to 1.3, down from near 2 at its peak. So what does that mean? There's another reading that shows the labor market softening but not dropping off a cliff, reinforcing the ability of the Fed to hold rates steady at their upcoming meeting. We also had a labor report. Employers added a greater than expected 199,000 jobs to the payrolls in November, while the unemployment rate unexpectedly fell to 3.7%. Average hourly earnings rose 0.4% for the month and were up 4% year over year. What does that mean? A solid report that showed the labor market remains healthy, but showing signs of slowing as the wage component continued to ease. The report indicates that the market may have been too aggressive in predicting a cut in rates. You've been hearing that. We're expecting some people are saying they're expecting the Fed to start cutting rates in March, but that may be a little too optimistic. And then looking again ahead this week, we talked about the Consumer Price Index report. Tomorrow, that came out this morning. Tomorrow is the FOMC. The Fed funds rate is expected to remain steady, but the press conference will be paid close attention to for signs that the Fed what the Fed's may be thinking about cutting rates in the future. And Thursday, we see retail sales. This report will provide a look at consumer strength heading into the holiday shopping season. I don't know about you folks, but man, I'll tell you, I feel bad for these local retailers because I'm done. I'm pretty much done my shopping, and it was all done online this year. I don't think I picked up anything locally, which is unfortunate. I like to support local businesses, but it's just so darn convenient. We're going to talk about market recap last week, but I'll just give you what Cornerstone said. So stocks were modestly higher on the week, and Treasury yields were a little changed as mixed economic data indicated a job market that was softening, as we were talking about, but not falling off a cliff. The market may be too aggressive in pricing near-term Fed cuts, and that could cause a modest pullback. So what they're saying is if we're being too optimistic about how the Fed's going to handle things and start cutting rates, we could see things pull back in the beginning of the year. But with economic growth continuing, it's likely that any near-term pullback would be relatively minor. Let's knock on wood on that one. Okay. Now let me just talk about what the numbers were for the market last week. So the Dow Jones Industrial Average was up 0.04%. So up 0.04%, very, very small. The S&P 500 was up 0.24%. The NASDAQ was only up 0.7%, but the year-to-date numbers are so strong. The Dow Jones is up so far year-to-date as of our close on Friday, 11.72%. The S&P 500 is up 21.79%, and the NASDAQ is up 38.74%. And I've said it individually in client meetings. I've said it to you, and I'll say it again. Nobody was expecting these kind of numbers going into 2023. 2022 was a very challenging year, and if anybody says that they were expecting these numbers, I'm just going to say they weren't quite being honest with you, because there are a lot of headwinds. How about interest rates in the bond market? So the 6-month U.S. Treasury ticked up to 5.38% from 5.35%. The 2-year U.S. Treasury went from 4.72% from 4.54% the week before, and the 10-year Treasury went up slightly, 4.23 to 4.20. We're still seeing what's called this inverted yield curve, where shorter-term rates are higher than longer-term rates, and that does not bode well for the economy in the long run. We talked a bit about that quite a bit about it in our last webinar last week. And then just one more analyst report, and I'll move on to the Financial 15. So this is from BlackRock, specifically iShares, which is a portion, a division of BlackRock. iShares are exchange-traded funds. We use some iShare funds, but that is not an endorsement nor a recommendation to buy, sell, or hold any issues issued by BlackRock. So they write, BlackRock and iShares specifically, we are like, and let me explain what I'm talking about. BlackRock is huge, probably the largest money manager in the world. So they have different divisions that report their different thoughts on the markets as a whole. So the key takeaways here are: we are likely to be at the end of the Fed's hiking cycle, but don't anticipate rate cuts until the second half of 2024. So BlackRock is saying, let's not look at March, maybe the second half of 2024. Investors piled into cash in 2023. It was such an easy and effective place to be. But staying there risks missing the returns in stocks and bonds often associated with the pause period between the last Fed hike and the first cut. And if you're allocated to cash now, because that's a correct allocation for you, and and if you've done your planning, and your plan should drive your investment decisions, and if you're working with us, you have your account segmentation, and you know exactly why you're holding a portion of your funds in cash and short-term bonds, that's fine. If you're just holding short-term cash and bonds because you're not sure what to do with the money, I just talked to you about the tremendous returns that we've had, 11%. Let me just go back and look real quick. 11% in the S&P 500, almost 12. 21%, almost 22% in the S&P 500. 11.7% in the Dow. 38% in the NASDAQ. So we're just talking about the U.S. markets. So if you just held cash because you weren't sure what to do with it, then you missed out on all those the difference between maybe the 4 or 5% you're getting in your money markets and the growth you could have gotten in these, in the stock markets or other markets. So that, you've got to have a plan for your investments, and the plan has to drive your investment options. Your financial plan has to drive your investment choices. 2024, BlackRock says, will be a year to pick your spots in fixed income, they say, which is bonds. We prefer pairing intermediate duration core holdings with differentiated income-seeking exposure. So what does that mean? So they're looking at intermediate duration is typically 7 to 9 year period. It can be around that area. So that's intermediate duration. Duration is the length of the bond, when it comes to maturity. Core holdings would be typical bond holdings, let's just say, to keep it simple. And then with differentiated income-seeking exposure, so maybe a satellite approach of some investments that give us higher returns is what BlackRock's saying. In equities or stocks, we favor adding downside protection and core exposures while taking targeted risk and lovable laggards. So downside protection has been very, very helpful and very, very important to our clients and our strategy. My 3 pillars: asset allocation, of course. You have to have good asset allocation. Principal protection. The studies show about a third of your money allocated to principal protection helps not only in down markets but in normal markets as well. And then account segmentation. Account segmentation is having a plan for each segment of your retirement life and so you know exactly how your funds should be invested. Your money should be invested for the times that you're going to need it in your life. Remember, investments, in my opinion, aren't age-based; they're needs-based and time-based. So, as outlined in the 2024 year ahead outlook, they say, this is BlackRock still, we believe the Federal Reserve is done with the current hiking cycle, but markets are overestimating the speed and scope of easing. We don't expect a rate cut from the Fed until the second half of 2024 as inflation remains well above the 2% target. For advisors, they write, the interest rate focus will shift from how high to how long, meaning the shape of the yield curve and trajectory of growth could be the key portfolio drivers in the new year. I think that's good information from BlackRock. Again, not a recommendation to buy, sell, or hold anything from BlackRock or anything else, frankly. All right, so now we're going to shift into our Financial 15 segment. So just pause with me a second. And we have a question. So first of all, hi, Doug. Doug always says good morning. Thank you, Doug. Good morning, Doug. And Kathy. Hi, Kathy. Good to see you. Kathy writes, hi, Mark. Question on QCD. If the custodian sends the check directly to the charity, does the check need to be cash deposited by the charity by December 31st to count for the year as well as with self-sent? It really, Kathy, so it really has to do with when it's distributed. So as long as the custodian is showing it as a distribution from your IRA, then it should be fine as long as it's a distribution. Let me rephrase that. As long as the custodian, and you can see that in your report. If you're a client of ours, you can see it in your Schwab access, or you can see it in your investment tracker access. As long as the custodian is showing it as a distribution out of your IRA prior to the end of the year, you're good to go. The issue is that when some people use these IRA checks and send them, those charities could just stack it up. Most don't, but they could, right? I was talking to somebody yesterday, and they have their CFO or financial director of their company. She takes 2 weeks off at the end of the year. So if that happens, what's happening? Checks are not being paid. They're not being deposited. That could be a real problem, and yours could sit. So you just want to check, and you can reach out to us, Kathy, and we can help you check. Unless it's not one of our accounts. But I think you have the answer you want. All right, so let me move on here. I'm going to switch over to the whiteboard. I'm going to be sharing my whiteboard with you. I got something funky happening here, so let's see if we can make this a little bit better. Okay. All right, so now you have my whiteboard in front of you, and this is the start of the Financial 15. So if you're just joining us, let me just go back here for a second. If you're just joining us for this Financial 15 segment, this is the financial planning portion of our weekly webinar, or what we call our Financial 15. So this should be about 15 minutes or so of our financial planning topic. And what you've just missed is the remaining portion of our weekly webinar that typically runs about 45 minutes to an hour. So for the last 40 minutes, we've been talking about IRA distribution issues, some headlines. We talked about consumer price index today, and we went over some investment returns from last week and some analyst reports. But if you're just joining us for this Financial 15, then please hit the like, notification, and subscribe button so you never miss an opportunity to hear one of our or watch one of our videos. Thank you, Kathy. Kathy got the clarification that she needed on the distribution. All right, so this is not an exhaustive checklist. I put this checklist together as we're going through things, and honestly, just right before our webinar this morning, I said to our lovely office manager, Jess, I said, hey, here's my list. Are we missing anything? And she added a couple key elements, so I appreciate that, Jess. So these are things that, most of them, right? So here, I'm going to draw a line here. These are things that must be done by December 31st for it to count for 2023. We're in year 2023. If it's now 2025 and you're just listening to this, it probably still applies unless the law has changed, but we're talking about 2023 today. So the first is RMDs. I can't talk about this enough. What are RMDs? If you don't know, RMDs are required minimum distribution. That's the amount that the IRS says you must take out of your IRAs. And if you don't take it, there is a penalty. The penalty used to be 50% of what the required minimum distribution was to be. Now it's 25%, and it can be reduced to 10. Still a significant penalty. So you must take your required minimum distributions. We've talked before about how that's calculated, but you need to calculate those RMDs or have your planner or advisor calculate those RMDs for you. It is ultimately your responsibility, though. You should know that. We help our clients. We distribute the RMDs. We keep a and Jess, who I just talked about, she does all of this really. So she keeps a spreadsheet and she makes sure that they're done throughout the year. But it is, in fact, ultimately the client's responsibility. So make sure your RMDs are distributed by December 31st. The money must leave your IRA account by December 31st. Folks, you never want to wait till December 31st to get these things done because, folks, a lot of people wait and the custodians get inundated with end of year requests. And they hit a point, and I don't recall what our custodian, we happen to custody at Charles Schwab, but it doesn't matter if it's Fidelity, it doesn't matter if it's Vanguard, it doesn't matter if it's whomever. They typically have a cutting off point where they say, we'll process this, but you're getting what's called best efforts. You don't want to count on best efforts. So RMDs, that's your first checklist. Make sure your RMD is done. Now, that is if with your own IRA, and today the rule is greater than 73 years old. If you turn 73 in 2023, you technically have until April 1st of the year following the year you turn 73 to distribute that RMD, but most people that doesn't make sense. But anything greater than age 73, you've got to process that RMD by 12/31 of the year. So make sure that's on. So your own IRA, and maybe it could be an inherited IRA. Now, I can't go into this because there's just too many ifs, but it could be that if you have an inherited IRA, you also have to take an RMD. And this is confusing for folks because even with the 10-year rule now, and yes, the IRS has allowed some people to forego, or they don't apply a penalty for the last 2021, 2022, and now 2023 because of all the confusion they've created around this. But if you have an inherited IRA, you may have to take that by the end of the year. And if you're not sure about that, I'm just going to pull this up again. You can contact us at questions@attleborowealth.com. That's questions@attleborowealth.com. And I just dropped my pen, so I'll be right back. Hold on. Okay, so that's RMDs. That's your first thing. How about tax loss harvesting? We did a whole video. We're right here. We did a whole video a few weeks ago about tax loss harvesting. So that is when you have positions, mutual funds, exchange traded funds, individual stocks, individual bonds, what have you, in a non-IRA account. Now remember, if we're looking at our account buckets, we have our taxable bucket, our tax-deferred bucket, and then our tax-free or tax advantage bucket. I'm talking about investments that live in this taxable bucket. If you have losses, embedded losses, unrealized losses in those investments, you bought X, I can't even name a stock, ABC stock at $50 a share, and now it's trading at $40 a share. You can sell that position if it's in this taxable bucket and realize that loss. And even if you wanted to still own that position, you rebuy it 31 days later and realize that loss, but that sale must be done by December 31st. If you don't do it by December 31st, it doesn't offset gains for this year. You can carry over those gains those losses for following years. But if you want to use those losses for 2023 to offset gains or even offset income, because you can do up to $3,000 a year to offset income, then you must do that tax loss harvesting by the end of the year. It's only for the taxable portion, not tax deferred, not tax free, only for taxable portion. So it must be done by the end of the year. Roth conversions. I get asked this all the time because Roth contributions, if you're eligible to make contributions, you can do contributions until your tax filing deadline the following year. So yes, I can still make a Roth contribution if I'm eligible for 2023 into 2024, the following year. But Roth conversions must be done by the end of the year. And you cannot wait. You should not wait until the last minute on this either, because same as required minimum distribution, the custodians, the people who hold your money and produce your statements, often say, we'll process this after this date, but it's best efforts. That means it may or may not get done, and they're not taking responsibility for it. And you've got to confirm these things. You send these, listen, we use Schwab as custodian. We have no ties to Schwab. They simply hold our clients' money, produce statements, do tax reporting for our clients. We are not Schwab advisors. We just use them as a resource. Schwab bought TD Ameritrade. A merger happened this year. It makes things more challenging. I'm sure it's going to be a great organization by the time they're done, but they're very, very overworked with this merger and really trying to pull things together. I'm really thankful that we started on the Schwab side, not the TD side, because we just all might be pulling out our hair. But my point being is that once you submit a piece of paperwork or an electronic request to a custodian or an investment firm, you can't just assume that it's done. You have to go in and double check. We double check all Roth conversions we do for our clients. We double check all required minimum distributions we do for our clients. You should do the same. You should do the same. Double check to make sure these things are done, because they must be done by the end of the year. Roth conversions must be done by the end of the year. You cannot go back. Retirement plan contributions. I'm talking about 401ks, 403b plans, simple plans, simple plans, retirement plans. These cannot be, you cannot do next year contributions, right? Contributions in the following year for the prior year. So if you want to put more money into your retirement plan, it has to be payroll deduction. You may have one more, maybe two more pay periods to increase your retirement plan contributions. This is why we start talking about year-end planning, and we do our financial planning with our clients every year. But we start talking about year-end planning in September, because if a client said, "Well, geez, I wanted to max out my retirement plan, but it doesn't look like I'm going to get there," they could put 100% of their income into the retirement plan if they wanted to maximize their contributions up to the end of the year. But you may have, if you haven't put as much money as you'd like into your retirement plan, you may still be able to increase those contributions for the remaining of the year. So retirement plan contributions. Charitable contributions, other than a QCD. Well, actually, QCD has to be done by the end of the year. That's not on here, Mark. QCD has to be done by the end of the year. And any charitable contribution has to be done by the end of the year. So you've got to get that done by the end of the year. So whether it's through traditional methods, you just write a check from your checkbook and you send it to your favorite charity, or you use the qualified charitable distribution. You're over 70 and a half. You want to take that money from your IRA up to $100,000 this year, increase for inflation starting next year, up to $100,000 per individual. You can send that directly to a charity, and that charity has the benefit of your funds. You have the benefit of never paying tax on that money that comes out of your IRA. That all must be done by 12/31. If you miss that deadline, it doesn't count. And the IRS won't allow you to do it for 2023. So charitable contributions must be done, whether directly or through QCD, by the end of the year. Tax withholding. This is one that we get asked about because we know that estimated taxes. So if you do a Roth conversion, for example, in this quarter, you've done it in today. It's 12/12/2023 today. You've just completed a Roth conversion for the year. Well, you don't have to pay tax on that until your estimated tax period. If you're paying it out of your taxable account or your bank accounts or something like that, you pay it with your estimated taxes. That's when it's due. In most cases, by that estimated tax due date, which is typically January 15th, unless that falls on a holiday or a weekend. So I'm not sure off the top of my head what it is in 2024, but I think you understand what I'm saying. So you've got to make that estimated tax payment by January 15th unless it falls on a weekend or a holiday in 2024. The tax withholding is different. So if instead of writing that check for your taxes out of your checking account or a distribution out of your taxable account, and you say, all right, well, I'm gonna convert $100,000 in my Roth or my traditional IRA to a Roth IRA. I'm going to convert $100,000 from my traditional IRA to my Roth IRA, but I'm going to withhold, let's just say 20% in taxes, and send that directly to the IRS out of that transaction. So I'm going to withhold that money from the transfer, from the conversion, and send it directly to the IRS. Not unlike what happens with your paycheck. When you get your paycheck, you get $1,000 pay. Your percentage, let's just use 20, goes to the IRS. So, $1,000, $200 goes to the IRS. $800 goes to your checking account. Same thing. In this example, if you're withholding funds, we did $100,000. Then $20,000 would go to the IRS in the form of tax. $80,000 would end up in your Roth IRA. That's withholding. I hope that makes sense. If it's unclear, you can say, can you draw that out? But I think that explanation was pretty clear. That must be done by the end of the year. You cannot do tax withholding for previous years. So you can't say in January, hey, do a distribution out of my IRA for $20,000 for that conversion of $100,000 I did in 2023 and apply it to that conversion. It can't be done. The tax withholding actually is one of the benefits of tax withholding is it's considered to be done throughout the year. So even if you did, a conversion in previous months prior to the fourth quarter, and you did tax withholding, it was considered, that withholding was considered to be done throughout the year. That's good, but you cannot do tax withholding for prior years. Let's just keep it as simple as that. So those are the must-dos, right? So these right here are, so we got RMDs, tax loss harvesting, Roth conversions, retirement plan contributions, charitable contributions, including QCDs, qualified charitable distributions, and tax withholding. All these are must-dos by the end of the year. Must-dos. If you're going to do them, you got to do them by the end of the year for them to count for the year. Now, again, I'm sure there's things on here. I looked at, the research I did was kind of our own checklist, but then I went on to, the web, the websites, and I looked at the CPA groups, year-end checklists, and so I looked to make sure, and I asked the experts in my office, like Jess, what else am I missing here? And Jess actually said, hey, how about tax withholding? And I did a head slap. Of course, tax withholding. Jeez. So thank you again, Jess. I'm going to write Jess here. Jess. And then these are the you should do. So we know the must do's. Here are your should do's. Should do's. Do. That's a do. Should do's. Review your plan. Review your plan, or have a plan to review your plan. But hey, take this opportunity to, all right, it's the end of the year. Let's just take a look at my plan. What's my plan? How are things unfolding? If you don't already have it scheduled, if you're a client of ours or you work with another financial planner for some unknown reason, make sure you're scheduled to review that plan at least in the 2024. So, you should make sure when your scheduled meetings are, have an idea of when that is at least, and take a look at that plan. You should also review your investments. I believe that you should be looking at your statements every month or logging in at least every month. When financial advisors, stockbrokers, financial planners, whatever you want to call folks, say, especially when the markets are down, just don't look at your statements. That's really, really horrible advice. That goes back to Bad Santa and the Grinch. Really, really horrible advice. I understand what they're saying, psychologically, don't let these downs get you. But this is when you should be paying attention and making sure that things are set up the way they should be set up. Because, folks, I'm here to tell you that most financial advisors, they set your investments and they kind of forget it. And that's really unfortunate. There may be automatic rebalancing in place and things like that, but not everybody. There are very good financial advisors out there, especially on the growth side. But I've just seen it in many, many circumstances where we get statements in and these things were built many, many years ago and never changed. And that shouldn't be the case. But you should be checking your statement. Remember, you're ultimately responsible Check your statements. Make sure that you understand at least, you don't have to understand every little detail of every investment. That's really not reasonable to expect that, but you should understand strategy. And if your values are down in any account or overall, you should just understand why. Doesn't mean, I will never say to clients that accounts are never going to be down. Of course that happens. Or individual investments are not going to be down, but there should be an understanding of why that is. So review your plan, check your statements. Check your beneficiary designations. Never, never, never a bad time to do that. Check your beneficiary designations. Make sure they're in line with what you want. Don't wait for a tragedy to happen where we don't have a beneficiary designation, everything flows to the estate, or the wrong person is named. In that example I gave, you folks just watching at Financial 15, there was an example in one of our Slott reports. You should go back and watch the weekly webinar about this, but a person didn't name beneficiaries of the IRA, so his estate was named as the IRA, and the one of the beneficiaries was the estate beneficiaries was saying, "Can we pass this to a charity?" And there were a lot of complications with that because there was no named beneficiaries. What could have happened and what should have happened is that individual should have named beneficiaries, of course. And then those beneficiaries over 70 and a half could have made a qualified charitable distribution of up to $100,000 to that charity that they wanted to fund for their lost sibling. Or that person could have named a beneficiary as brother or sister as they list it, and then named a contingent beneficiary of the charity. So in that case, if brother or sister passed before the individual who ended up passing, it would flow directly to the charity. Or if the person who wrote this letter to the Slott Group would have inherited that money, they could have disclaimed it and said, "I don't want it." It passes to the next person, and it would end up to the charity. Very, very simple. Excuse me. So that would have been very, very simple. Some really simple estate planning that would have made things much easier. So check your beneficiary designations, review your plan, your estate plan, your investment plan, your financial plan as a whole. If you don't have time to review it, make sure that's scheduled for 2024, and set some goals. This is important. Set goals. Set goals for what you want to achieve in 2024 and beyond, and you're much more likely to achieve them. And we all know that. Here we are. It is 10:59. This is the end of our hour. I hope that was helpful. I hope it was enjoyable. What we just went over was we went over some headlines. The Consumer Price Index was the big headline of today, and I read to you some of the Consumer Price Index BLS report. We went over some analyst reports and talked about what occurred in the market last week as far as returns and some of the movement. We went over some questions and a report from the Slott Group. Excellent IRA distribution resource for us. That's the Ed Slott Lead Advisor Group. I'm fortunate to be part of the Master Lead Advisor Group, and I sit on Ed's advisory board right now. And then we went over your Financial 15, and that is your year-end checklist. So I hope that checklist was helpful. That's our checklist. I wanted to share it with you. You should have your own checklist. If you have anything different on that checklist, your financial checklist, I'd like to hear about it. And you can reach out to us with that information to questions@attleborowealth.com. That's questions@attleborowealth.com. If you want to schedule time with us, if you're not already a client, you can reach out to us for a 15-minute discovery call to questions@attleborowealth.com. That's just questions@attleborowealth.com for that 15-minute discovery call. If you're a client and you need to see us, you can call us anytime and schedule an appointment, or reach out to us and schedule an appointment. Just for clients, I want to remind you that our office is closed from December 25th until I think it's December 29th, that week between the Christmas and New Year holiday. So if you need something done in that time, be sure to reach out to us as soon as possible. But it was a pleasure talking to you today. Have a great week. Reach out to us with any questions, and we'll talk to you soon. Take care.